Coming up on Market to Market. Secretary Vilsack eyes the challenge of President Obama's 2014 budget. Protestors seeking immigration reforms press Congress for solutions. And the USDA supply and demand report reveals a tight stocks-to-use ratio for corn. Those stories and market analysis with Alan Brugler next.
Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success. This is the Friday, April 12 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Concerns that the sequester and new taxes enacted at the beginning of the year might have a negative effect on the economy appear to have been realized. According to the Commerce Department, retail sales fell 0.4% last month as consumers kept their wallets in their pockets. When the volatile categories of autos, gas, and building materials are pulled out of the equation, core sales only fell 0.2%. As consumers seemed reticent to open their pocketbooks, producers cut back on their orders of wholesale goods as the Producer Price Index fell 0.6%. Core PPI, which excludes volatile food and energy prices, actually rose 0.2% in March. The stock market has experienced several record sessions over the past few weeks. The Dow Jones Industrial Average and the S&P 500 spent most of the week in record territory, only to fall back slightly on Friday. At the point when Wall Street was riding high earlier in the week, the Obama administration released its version of the 2014 federal budget. No department escaped the fiscal axe, including the agency tasked with controlling benefits for farm country. The ongoing budget battle in Washington ramped up this week as President Obama sent Congress his $3.8 trillion spending request for fiscal year 2014. Seeking common ground with Republicans, the president's plan aims to reduce the federal debt by $600 billion over the next decade. Initiatives include rebuilding America's infrastructure, overhauling education, and raising the minimum wage, among others. Some suggest the White House recommendation may represent the nation's best hope to replace sequestration with bipartisan deficit reduction before another potential debt ceiling fight this summer.
If we want to keep rebuilding our economy on a stronger, more stable foundation, then we've got to get smarter about our priorities as a nation. And that's what the budget I'm sending to Congress today represents. A fiscally responsible blueprint for middle-class jobs and growth.
According to the Office of Management and Budget, the anticipated cuts to 215 programs are projected to save over $25 billion next year. Under the plan, USDA would see a 5.9% decrease from its 2013 appropriation, taking a bite out of direct payments to farmers and government assistance for crop insurance. The proposed budget also would streamline international food aid.
Good morning, everybody.
The Obama administration claims many farm subsidies simply are not justified, as record farm incomes are forecast to continue. The Agriculture Department predicts net farm income will increase this year by 14% to $128.2 billion, giving farmers their highest income when adjusted for inflation since the 1970s. Secretary of Agriculture Tom Vilsack claims the USDA is committed to what he calls the farm, food, and jobs safety net for agricultural producers, but he views the president's proposal as an opportunity to negotiate a better deal for taxpayers.
You know, this is a challenging budget, and it requires us to think anew and think differently about ways in which we can provide the same level of assistance or help, or in some cases more assistance and help with less money.
USDA initiatives like the Supplemental Nutrition Assistance Program, or SNAP, and other social programs account for the vast majority of the total Agriculture Department budget. Farm and commodity programs make up less than 20% of USDA expenditures. The budget for SNAP, formerly known as food stamps, has more than doubled since President Obama first took office, due largely to the recession. The expenditure, which provides food assistance, is expected to cost more than $80 billion in 2014.
It's time to focus on the real problem here in Washington.
Continued calls from conservatives to overhaul SNAP have largely fallen on deaf ears. But the administration is throwing strong support behind the program in what it calls a time of continued need. The president's proposed budget would cut spending on government programs like Medicare and Social Security by $130 billion over 10 years. Those concessions, while loathed by some Democrats, are viewed as an olive branch by Republicans. Skepticism of a grand bargain remains, however, as the right adamantly rejects the president's insistence on tax hikes for the wealthy and some businesses. But the struggle is not over in Congress. While lawmakers work on reining in spending, rural America waits for both parties to find a solution to the elusive 5-year farm bill. It is estimated there are 11 million undocumented laborers residing in the United States today. What to do about either making them citizens or sending them back to their home countries has been a quandary since the U.S. was formed almost 240 years ago. Last week, plans to change immigration policy for the first time in 27 years sent lawmakers into a frenzy of negotiations. Accusations of amnesty for the undocumented were heard alongside calls for the measure to be approved. This week, as policymakers met to hammer out details, a grassroots coalition of farm labor groups worked to bring pressure on Congress by taking their cause to the streets. Thousands of immigrants and activists rallied across the U.S. this week in a coordinated set of protests aiming at pressing Congress to approve sweeping immigration reform. If passed, the measure would create a path to citizenship for the 11 million immigrants living in the country illegally.
I will tell you what I've been telling people across the country. Work hard. Push us. Keep pushing us. And together we will deliver immigration reform this year.
Demonstrations took place not only in Washington, D.C., but also in states across the U.S. In Atlanta, Georgia, more than 1,000 people marched, calling for comprehensive changes to immigration policy and an end to deportation. In Los Angeles, California, protesters marched to the office of Senator Dianne Feinstein, a Democrat, to deliver a letter that called for immigration reform, stating, "The future well-being and prosperity of California depend upon an immigration system that truly respects and values the humanity and contributions of immigrants, undocumented and documented."
We need right now immigration for 11 million people that we have here in the United States working on the shadows. That's inhumane.
According to labor and industry estimates, up to 80% of the nation's approximately 2 million farm workers are here illegally. Growers say they need a better way to hire labor legally, but wages and visa caps have been sticking points between the United Farm Workers, or UFW, and agricultural interests. The UFW, a farm labor advocacy group, contends that growers are trying to push farm workers below their current average wage of $10.80 an hour. Growers argue wages are skewed by a small number of high earners and that most farm workers make less. On Thursday, the bipartisan Gang of Eight, senators who were tasked with retooling the nation's immigration laws, announced that they had reached an agreement. The landmark legislation would overhaul legal immigration programs, crack down on employers who hire people in the country illegally, and boost border security. Senator Dick Durbin, a Democrat from Illinois and a member of the Gang of Eight, believes the bill, which enacts the biggest changes to U.S. immigration law in more than a quarter century, could be introduced as early as Tuesday.
Next, the Market-to-Market Report.
Grain prices plunged 2 weeks ago when the Agriculture Department predicted U.S. farmers would plant 97.3 million acres of corn. If realized, that would be the most corn planted since 1936. USDA predicted a 1% decline in soybean plantings to just over 77 million acres. That would still be the fourth largest crop on record. The post-report hangover continued for corn and soybeans last week, while wheat prices recovered a bit on news of decreased winter wheat production. This week, USDA officials reported on what's left in the bin and how they think it may get used. The World Agricultural Supply and Demand Estimates report showed ending stocks for wheat 15 million bushels higher this month because of reduced demand for feed. Despite a predicted increase in seed used for planting, the carryout rose to 731 million bushels. Even with slightly more wheat available, the stocks-to-use ratio dipped to 30%, the smallest in 3 seasons. Projections for global wheat supplies also were higher, primarily due to balance sheet revisions. Overall, private analysts deemed world and domestic wheat supplies adequate. While the supply of wheat is no longer considered to be burdensome, the winter wheat crop is showing signs of stress. In the 18 states producing the small grain, 64% of the crop is in very poor to fair condition, down 2 percentage points over last week's survey. USDA revised corn ending stocks upward by 125 million bushels over last month. The increase pushed estimated supply numbers to 757 million bushels. However, the stocks-to-use ratio dropped to 6.8%, the lowest level since the 1995-96 crop year. The tighter margin leaves virtually no room for weather or production shortfalls. According to the report, lower exports and decreased feed use due to high prices are being offset by increased ethanol production. Larger than expected supplies and lower prices, combined with favorable margins for producing and blending the predominantly corn-based fuel, are expected to limit a year-over-year decline in ethanol production. And U.S. corn exports are expected to be off 25 million bushels, as foreign competition and overseas sales are predicted to take a bite out of the U.S. market. U.S. soybean ending stocks are forecast to remain at 125 million bushels. That's another commodity with a razor-thin margin for error and a 4.1% stocks-to-use ratio, its lowest level in a decade. Globally, the supply was bolstered by a record crop in South America, which is expected to help meet China's growing demand. The market's immediate response to the midweek news was mixed. Corn received a small boost while soybeans and wheat settled lower. Tighter supplies, weather, and crop condition pushed the grain markets higher. For the week, May wheat gained 16 cents, while the nearby corn contract moved 30 cents higher. Soybeans rallied this week as the May contract posted a weekly gain of 52 cents. Nearby meal prices tagged along, adding $8.40 per ton. In the softs, cotton continued its downward trend as the May contract posted a weekly loss of $1.21 per hundredweight. In the dairy market, May Class 3 milk gained 48 cents, while the June contract moved 13 cents higher. Over in livestock, the June cattle contract fell 75 cents, nearby feeders were off $3.38, and the June lean hog contract moved 20 cents higher. In the financials, the euro gained 66 basis points against the dollar, crude oil lost $1.41 per barrel, COMEX gold declined by $74.50 per ounce, and the Goldman Sachs Commodity Index lost a little more than 5 points to settle at 623.60. Here now to lend us his insight on these and other trends is one of our regular market analysts, Alan Brugler. Alan, welcome back.
Great to be here.
We've got a lot going on this week. One of the issues that's been on the mind of a lot of exporters recently has been the dollar. We've seen it climbing. This week, what's your take on where the dollar might be headed?
Well, I think the dollar's starting to pull back a little bit here. We saw that against the euro particularly. Actually what's been driving the dollar up mostly has been the Japanese yen. Japan's been trying to weaken their currency, kind of take a page out of the U.S. playbook and weaken the currency, stimulate some exports. That's been really pushing the dollar up. But the dollar itself is a basket of currencies, the dollar index, and we saw a little bit of a correction there this week, which is actually helpful for commodity exports and commodities that are priced in dollar terms.
Now, looking at the yen, they're predicted to continue to try to weaken the yen. Is that going to have a long-term impact on the dollar's place in that basket, do you think?
Well, the portion of the basket that's yen denominated, yeah, it'll be kind of a drag on the dollar, or a push on the dollar, I should say. But keep in mind that the U.S. and several other countries have been trying to do the same types of stimulatory things, and everybody can't do it at the same time, at least and have any effect on the currency.
Okay, so we're all sort of level just...
Yeah, the dollar's cheap compared to what is the way I put it.
All right, good way to think about it. Well, let's take a look at exactly what's being exported. Let's talk the wheat market. We saw some heavy freeze across much of the wheat belt. But then we also saw in the report, world supplies are looking pretty good. Can you talk to us about what we should expect with wheat here in the upcoming week?
Well, this week and probably next week as well, we'll be very interested in the amount of freeze damage that we saw. We had that freeze at the end of March that affected some of the crop in Oklahoma, but much of the crop hadn't advanced to a stage that it was vulnerable to the freeze. We had another cold snap this past week, and it looks like some below normal temps again this coming week. So we're continuing to nick that crop. If there's snow cover, it doesn't hurt it so much, but if it's jointed or starting to get further on in the heading stage or shooting out stems, then it's more vulnerable. So we're definitely losing some hard red winter wheat production, which is the bread wheat. Soft red, it tends to be grown in a different area of the country. It's actually getting pretty good rains, and it's a little behind in maturity, but doing okay. So we think overall the wheat crop is down a little from where we had estimated that it would be, particularly the hard red. On the global side of things, though, everybody likes growing $8 wheat or $7 wheat. And so you're looking at potentially fairly large crops in Ukraine and Russia. India's got surplus wheat from last year they're still trying to sell. So it's kind of like the U.S. and Canada down, but the rest of the world's trying to make up for it.
So now how is the market going to handle that? What's the best way for producers in a situation that they're in right now?
Well, I think you have to be fairly defensive right now. The normal seasonal pattern, if there is one, is to decline into May or June as we get into harvest, and then once the harvest gets put away, it goes back up. Now there are years when we have an exception, but we've done a fair amount of forward pricing, and both in the cash market and in terms of hedges, and we think we just want to stay defensive until we know just how much the crop has been lost to that weather.
So keep an eye on it, see how things shake out in the next week or so before we get a true idea of what's happening on the fields in the Midwest.
But with the potential for the second or third largest world crop this year, you can't wait to sell. You've got to have something on the books.
Don't wait till harvest and get caught up in. All right, well, let's take a look at corn. We did see corn kind of reverse its trend that we've been looking at for the past couple of weeks. We saw a rise this week. What's driving the corn market? Can you talk to us a little bit about the supply and demand estimates?
Well, basically, as you know, March 28th, we got a bit of a surprise on the grain stock side. There was more corn sitting there in the country than what the trade had anticipated. If you go back in hindsight, you can see that, well, exports were way down, so that stuff didn't get shipped out of there and so forth. But the story this week was the USDA basically decided that most of the, quote, excess corn that was around was going to be used between now and the end of September. The beginning of September. That we're basically still in a price rationing mode. We knocked the price down. That ethanol consumption will go up, feed use will go up, exports will probably respond to a degree, and therefore they did not fully reflect that stock surprise in their year-end projections. That's bullish. And then we got a little bit of life in the wheat market, which had been used as a substitute for corn feeding, and that also helped the corn.
So now looking at old crop corn, this current rally that we're on, how high do you think we can ride this? What's the trade's best level of support to keep an eye out?
Well, we've got some chart resistance in the 650s, and we got some more in the 675 level. I'd be very surprised to see it go above 7 on the board.
Okay.
We have to be a little careful here because there's probably no deliverable stocks against the May futures, so there's potential for a little bit of speculative short squeeze there. The commercial elevators already are moving their bids to the July, though, so that doesn't mean the farmer will necessarily see it. If the cash bid's based on the July, but it's the May that's going up, you don't get the benefit.
Sure. Now taking a look at new crop, what's your best advice to producers out there?
Defensive. We are talking about the largest acreage since 1936. I think we're going to get a little nervous about late planting here. The USDA is probably going to come out with their first actual planting progress report for corn this week. Just remind people that while we had 15-20% of the stuff planted last year, the average for this week is only 4%. So we're not that far behind long-term history. We are behind last year. Where that'll become an issue, though, is if we plant average or later and then have a hot summer. Okay, the advantage to the early planting is that you get better pollination.
Certainly.
So any delays in planting, while maybe not technically a problem, are a problem if it's followed by a hot, dry summer.
If we get a repeat of last year's summer, temperature-wise.
Or even 2 years ago when we had the heat with adequate moisture, it still hurt the yield.
Certainly. So go ahead and plan on selling into this rally if you've got some uncommitted bushels for new crop, do you think?
I think there's a lot of producers that are not as far sold as they probably should be, given the potential for the downside. Now, flip side of that is that the 33 out of the last 37 years, December corn futures have rallied enough on a weather scare to take out their January high. And that was 605 a bushel. So there are 4 years it didn't, but the odds are pretty good that we'll have some kind of weather scare at some point. So it doesn't mean you have to load up the sales here to the max.
All right. Well, let's talk soybeans. Soybeans are also being carried along on this recent little rally we've got. What are your thoughts on old crop beans? How did the market interpret the supply and demand estimates there?
Well, actually, that was bullish as well because USDA left the ending stocks at 125 million bushels. Trade been looking for a 10 or 15 million bushel increase there, a little looser stocks use situation. USDA raised the exports another 5 million, basically saying we're still selling more. They were cautious, I think, in that because there are cancellations. There's a potential that some of the sales that are already on the books don't end up getting shipped. People question why they didn't go a little further on the export sales estimate, but that's why. And the other reason is we're basically running out of beans at the rate we're going. So it's bullish, but again, South America's got a record crop. USDA did not cut the South American production, which had been anticipated. They left the numbers fairly high. And so there's a very narrow window for the U.S. to export in. And in fact, the last 5 weeks, our exports have been running below their normal pace. So the South Americans are already starting to eat into our ability to ship.
And that's been something we've been talking about for a while now. They're actually beginning to ship out of South America and get caught up. So looking at that, what sort of resistance levels do you see on old crop beans?
Well, 1440, 1450 is a pretty stout resistance, and we're not that far away from it for old crop. The new crop has been unable to rally, really. We've got this short covering type of a thing going in the old crop in November. It's just kind of laying there. So, again, I think you have to be fairly heavily hedged on the new crop. Maybe not so much on the cash side if you're not sure about your weather and your production, but have some protection against that long-term trend to go down here.
Okay, but we still could get that weather scare.
Yes.
This early in the year could happen. Let's take a look at the softs. Looking at cotton, we saw a little bit of a sell-off last week. We're down a little over $1.20. What's your thought on the cotton market?
Basically, the market rallied, the new crop, the December rally, trying to buy acreage. We actually had an 18% change in price from the fall low until the recent high. So that's a fairly substantial move. And then USDA told us in the planting intentions report it really didn't succeed. It really didn't get that many acres, but apparently we've given up. Okay, the profit taking has kicked in. The old exports are still doing well in the old crop, but USDA left the projected old crop stocks unchanged at 4.2 million bales. So a little of the speculative steam's coming out of the market. And we do know that there's record large world stocks of cotton. So it's hard to argue that we need to go up right here.
So there is a ceiling. Just looking at that record large world, there's a ceiling on cotton. We're not going to get a lot of excitement into the market.
Yeah, we've started to move up we've just about finished our old crop cotton sales, and we recommended people move up their new crop as well.
All right, well, let's take a look at livestock. We saw cattle futures get huge on the 28th after we saw the limit down days in corn. Since then, we've trended down a little bit this week. Can you talk to us about where you see live cattle headed?
Basically, the meat at business is the key here. All right, we've got 94%, 93% of last year's cattle numbers on feed. That's a positive, less supply. On the other hand, export sales have been iffy. Not that good in February. March got better because the Japanese came in and made a big order. But the box beef price is hanging in at fairly high levels historically, still 6 or 8% above a year ago, but unable to crack the $2 per pound for the whole carcass, all right, the $200 mark. As long as that's the case, the futures are kind of limited to 128 or 130 for a maximum price. And that's basically what we've been seeing. Cash trade this week was 128.
Okay. So we're going to have to wait and see if grilling season can get people out there, get some of this meat sold, and consumers willing to pay a little bit more.
You nailed it.
All right. Well, let's talk about feeders. As we look at that in the live cattle market, we saw feeders pretty good sell-off this week, just shy of $4. Where do you see the feeder market headed in this environment?
Well, feeders are fairly scarce in terms of numbers. You know, the calf crops are down, 50-year low, and so forth. But the problem is, of course, corn rallied this week, 30 cents per bushel rally. It gets priced into the other inputs, which the number one other input is the feeder cattle. So feeders were going to go down unless you saw a big rally in the live cattle, so that the feeder could pass that on, and that didn't really happen this week.
So now, as we look out to the future on feeders, we're just going to be keeping an eye on corn. Is that going to be the main determination on price, in your opinion?
Well, the live cattle price has statistically a stronger correlation, but the corn is the other main variable. So if one's moving and the other isn't, that will drive the price. We think there's pretty good technical support, chart support in the 133 area. The funds had a record large long position in feeder cattle. Now they're actually back to a negative position. So we've washed out all that selling. That's out of the market now. The market should be a little clean, technically speaking. And if you get a little break in corn, or if the cattle get some traction here with the grilling weather, then I think you can see the feeders go back up.
All right, well, let's take a look at hogs. We saw a bit of an increase in hogs. Where do you see the hog market headed?
Seasonal tendency would be for hogs to go up into the summer here because we have smaller slaughter numbers, less production. You get the barbecue season going and some other things. Right now we're struggling a little bit because the export market's not doing well. The Census Bureau put out the February data this week. We were down 12%. USDA started to report weekly pork export sales. The first week looked pretty good. 35,000 tons. Last week was in the teens. So the world market's saying we'd like to pay a little less for your pork, and once we get that to happen, then the market will go.
All right. Good things to keep an eye on. Thank you so much, Alan, for being with us today.
My pleasure.
That wraps up this edition of Market to Market. But if you'd like more information from Alan on where these markets just may be headed, visit the Market Plus page at our website. You'll find expanded market analysis, audio podcasts, and streaming video of our program, as well as links to our Twitter feed and Facebook account, all free at the Market to Market website. And be sure to join us next week when we'll examine the impact of record-breaking growth in the wind energy sector. So until next time, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success.